Welcome to News You Can Use in Your Personal and Professional Lives. Hi, I'm Dan Finn, and for the past 35 years, I've been helping clients achieve their long-term financial security by providing them with various tax-advantaged income options when they are facing some of the most consequential decisions of their lives. Thank you for the opportunity to be of service to you today. In today's installment, we're going to explore the IRS-compliant tax deferral strategy known as 453 Structured Installment Sales. If you know our firm, you know this topic has been a consistent focus of ours for a number of years, and there's a good reason for that. It helps our clients save money. If you've ever sold or are thinking of selling a business, piece of real estate, or any other significant asset, you probably had that sinking feeling when you realized what the tax bill was going to look like. Today, we have a special treat because we're going to hear from an actual tax expert who understands this topic and will demonstrate how this strategy can fundamentally change that picture while providing his unique perspective as to why structured installment sales activity continues to grow. My guest today is Jesse Lipscomb, founder and CEO of Roadmap Tax Services. Jesse is an enrolled agent, which is the highest tax credential the IRS grants, and is also a licensed insurance professional. That combination of expertise sits right at the intersection of everything a structured installment sale entails. I recently had the pleasure of partnering with Jesse on an actual structured installment sale transaction, and as I was able to witness firsthand his uncanny ability to quickly analyze a complex situation, break it down to make it look easy, and guide his client through the process to reveal the money-saving potential that was at stake. He was able to demonstrate to his client in real time the significant tax savings he could realize using this method. Jesse, great to have you here today. Thanks so much for agreeing to share your expertise with us, and welcome.
Thank you. Thank you so much, Dan. I really appreciate it.
Jesse, real quick before we get into your presentation itself, I want to mention to our viewers that you'll be sharing with us today is an excerpt from a more comprehensive tax planning webinar you often conduct for homeowners and real estate investors. Compliments to you for your commitment to providing such valuable education to your constituents. With that, I'll get out of your way and turn it over to you so you can walk us through your talking points, and maybe we can discuss things further as we go along.
Thanks, Dan. Yeah, Section 453 is a very powerful strategy. Typically, when I'm given that presentation, tax planning for homeowners and real estate investors, we discuss sections 121, 1031, and 453. 1031 is when you want to sell your rental property and defer the gains into a new one. 121 is that 2 to 5 year exclusion for your primary residence. But what do you do when you have a house that you bought for $500,000 that you're selling for $2 million? Your $500,000 gain or exclusion of Section 121 still results in $1 million gain. And that's one of the examples where Section 453 is so powerful. We can apply it in conjunction with Section 121. We can actually split it in conjunction with 1031 on rental properties. And it's another great strategy for businesses when you sell. We're going to talk about the differences between a traditional sale and an installment sale, and then we're going to talk about the structured installment sale itself. So in traditional sale, you've got a seller, you've got a buyer. The seller brings the deed to escrow. Buyer brings the money through escrow. The seller gets the money. The buyer gets the deed. Clean. It's easy. No problem. In an installment sale, this is where the buyer typically is going to come in with a down payment, and the seller is going to be the bank. This is seller financing, the traditional installment sale. Now, most of you listening out there will immediately think of one of the two risks of this transaction. That's specifically default. What if they don't pay me? And I agree that is an unfortunate potential risk of carrying a note on a sale of your own property. But I'm here to tell you that prepayment is worse. I had an experience early in my career where the father of my client had already sold his $5 million commercial property via an installment sale, and everything was great. Everything was good. They were getting 6% return. They were getting income. He passed away. It went on to his adult children. They were enjoying the income on it, but then interest rates went down, and the buyer refinanced that note and paid off the note. Now, what happened in that situation? In their situation, it was a massive tax bill, because the key to installment sales is stretching that tax liability over time. And so a risk of, or the two risks of traditional installment sales, somebody not paying you where you have to get the property back, and somebody prepaying you where the tax strategy itself fails. Those risks aside, Section 453 is potentially really powerful because it allows us to do tax bracket optimization, trying to get somebody into the 0% tax brackets. And I'm going to explain that in the next slide. In addition to the tax deferral, why? Because you only pay taxes on the money you receive. So if you stretch something out over 10 years, you potentially get yourself in the 0% bracket. It's a double win. So let's talk about the long-term capital gains brackets for a moment. 2026, a married couple can earn up to $98,900 and be taxed at 0%. And we look at this, the 15% bracket starts again at 98,000 married, 49,000 single, and then it goes up and up. But what if we factor in the standard deduction and we factor in the new $6,000 or $12,000 senior deduction? All of a sudden, we can realize that you can make $146,000 married jointly and still be in the 0% long-term capital gains bracket. This is really powerful. Think of...
If I could just interrupt here quickly, Jesse. So if I understand it correctly, if somebody were, so let's take a different case. If somebody had $450,000 they were trying to defer, they defer that over 3 years, they've gotten rid of that capital gains altogether. Is that, I got that right?
Yeah.
450, I should say. Yeah.
Yeah, if they had a $450,000 gain and no other income, that is true, assuming that they're 65 years or older. The same exact example, let's assume $100,000 a year of regular income, right? Whether it's Social Security, IRA, whatever. 146 minus 100 is $46,000. What does that mean? Dan, that means that same $450,000 gain, if we push it over 10 years at $45,000, $46,000 a year, they'll hit 0% tax on that by stretching it over 10 years.
Very powerful.
Yeah, no, it's really, and now we go back to the installment sale itself. Again, we've got the risks that we need to overcome. So let's talk about that. How do you overcome prepayment and default? It's easy. It's through Section 453, we do a structured installment sale. So just like an installment sale where we're agreeing to make payments, buyer to seller, in the structured installment sale, the buyer agrees to make periodic payments. So that agreement, that written agreement through the sales documents, can be assigned to an assignment company, which will then coordinate with an insurance carrier and guarantee the income payments to the seller. Now, what do you have? The risk of default is neutralized. We're insuring the payments. And there's not going to be any prepayment because, again, they're structured payments. So now what we have the opportunity is to use a real-world example. Again, that same $2 million personal residence that I discussed, you have $1 million basis, $500,000 acquisition, $500,000 Section 121, 2 of 5 years, but you still have $1 million gain. And it depends on how your other income is. You could be at 20% IRS, 3.8% net investment income tax. California's at 13.3%. And you're paying 37%. That's $371,000 by selling your primary residence. That's expensive, huh?
Yeah.
So what if we structured this on a 20-year note? Okay. As we could see earlier, we had a $2 million sale and $1 million basis. So that means that 50% of any payment would be profit and 50% of any payment would be tax-free basis. So take 2 million, divide it by 20, that's $100,000 a year of income, 50% of which is taxable, which is putting the client then in the 0% long-term capital gains bracket. And the question is, would you be willing to save $370,000 by taking the money at over time? A lot of people would say yes.
And
Okay.
this does not
And
include the California or state tax, whatever it would be. So there'd be some for the state tax. That's a little different. And it also doesn't include any interest that would really be on top of this, correct?
you're absolutely right. I found it really depends on the total financial picture of the taxpayer. But for married couples making less than 100,000 total, and in this case, it'd be the $50,000 of Section 453 income plus any of their other income. But if you're a California taxpayer and all in, you're under $100,000 married, the taxes are not onerous. They're reasonable. I did a strategy on a $500,000 gain. We stretched it over 12 years, and the client ended up paying zero, literally zero taxes, state and federal. Keep in mind, California doesn't tax Social Security benefits. So whereas the IRS, it's 85% taxable, California is just zero. And so the vast majority of people, the majority of their income is Social Security. You take that off the table, even the installment sale income will typically be taxed at very low brackets for an average taxpayer.
Yeah, it just makes you wonder, what are you seeing on this? Now you're everybody's not is pretty new to the structured installment sale concept because it's only just now really starting to gain some serious traction. What are you seeing from in your profession about the interest in this and how your sellers are responding to this suggestion?
It's very interesting. We can put the clients into a couple of different buckets. It's funny, I just did a training with my staff this morning, and I said, the first thing you got to ask somebody is, if taxes weren't a thing, what would you do with the money? They're going to tell you one of two scenarios typically. Either A, they want to take the proceeds and buy another property. Whether that's another primary residence or a rental, a 453 isn't the correct strategy for that, okay? Because you need lump sum money. However, whether it's a rental property or primary, if the answer is, man, I'm tired of toilets, tenants, and trash, and I want to sell, and I just want the monthly income. You don't want to pay a bunch of taxes. I don't want to deal with tenants. I don't want to mess around with, some of the other strategies there where you're getting a partial interest in a commercial property. I just want a clean exit. Now we're talking home run territory. And in that example I told you earlier about the client that had the $500,000 gain, it was literally their answer. I said, if taxes weren't a thing, what would you do? He said, I would literally take the money and put it in the bank and draw income off of it as I needed it. That sounds like we've got a great solution for you. And he saved something like $200,000 in taxes. It makes me feel good helping people win.
Yeah, and this works primarily on probably houses where your gain is going to be anywhere from what we're seeing anyway. And I don't know if your experience is different, somewhere between 500 to maybe up to $5 million in gain. Those are the people who stand to benefit the most by using a structured installment sale.
I would agree. I might lower that down to 300,000, but anywhere in there, if you have $100,000 gain, it just doesn't make any sense. It's frustrating, right? 300, 500,000, up to $1 million. A lot of times we can get you in the 0% long-term capital gains bracket. In my example, a couple of the examples in this presentation, I've talked about 10 years or 20 years. It depends on the age of the seller. We've got a lot of options to take those payments over time.
Yeah, and I have to compliment you too on that last transaction that we worked on together. You had your Excel spreadsheet and you were going over with your guy in real time. You were saying, well, if we change this, here's what you're going to pay. And if we move it to do it this way, here's what you're going to pay. That's very persuasive to be able to see right immediately what the tax savings are going to be. It's hard for me to imagine anybody not being interested in this.
It's like the whole concept, Dan, of immediate gratification. If you don't need the money for a specific purpose and we can get tax deferral as a strategy, then you get tax optimization, meaning if we can defer the taxes over time, income over time, a lot of times we can get you in that 0% tax bracket. And almost worst case, we take you out of 23.8 plus state, and we even get you down to 15. That there's still a lot of tax arbitrage there.
That's money in the bank. And
Yeah.
I love it partnering with someone like you, because we can't give tax, legal, or accounting advice. You can't give legal advice because you're not an attorney, but you can give an accounting advice because you're an enrolled agent by the IRS. So you can do that. And that's when you've got an actual tax person being able to say, here's the quantifiable savings you're going to realize if you do this.
Yeah, we've literally built our tax practice around the concept of tax strategies for homeowners and real estate investors. If you're selling a property, the opportunity to evaluate what your potential capital gains are first, and then identify potential strategies to reduce and or eliminate the taxes on that gain is what we love to do.
Awesome. Terrific. See, anything else I want to cover here, Jesse? If not, I guess
Well,
on behalf of Jesse and myself, thank you all so much for joining us today. Hope you found this to be a very valuable session. Here's Jesse's contact information. Make sure you take that down. Back up there once, Jesse, if you could. Make sure you take this down if you need to get a hold of him for a situation to ask any follow-up questions. And then onward to I'll add my appreciation to all of you for taking the time to watch this video. Feel free to share with others who you know might benefit from this information. And if on the last slide here, if you have any questions or if you have a situation you'd like to discuss, please don't hesitate to reach out. We're here to help. Be sure to visit our companion website at mystructuredsale.com, where you'll find additional resources designed to help you better understand this dynamic tax deferral strategy, as well as other videos hosted on our YouTube channel. We'd love to hear from you. Thanks again, everybody, for joining. All the best.